Hey, my name is Michael and welcome back to my YouTube channel. This is the third episode of the Real Estate Forum Deep Dive, where we go over questions that people have posted online that either have been not answered or I think could be answered in a different way to really get you thinking. And these questions could be anything from how do you set up an LLC or when should I buy my first property? The amount of questions and the variety of questions are limitless. All right, let's go ahead and get started. We own a home in Texas and also our personal residence is in Tennessee. If I let my son live in the Texas home to take care of it in lieu of rent, can I draw up a lease between us? We will be financially maintaining the Texas home, but he will be responsible for utilities. Will I be able to get any tax advantages for repairs? We want to protect ourselves. Do you have any suggestions? Okay, so this is a very interesting question. Let's take it as let's zoom back a little bit and let's consider what you're saying here. So basically what you're saying is that the tenant would be your son. They would pay you rent. They would pay utilities and then you would cover any repairs. And then are there any tax advantages to this scenario? So what I would say to you is that if you have your company set up, as an LLC or a business, and for that matter, and you have someone paying you rent and it's on terms, it's on a legal lease written out, I would consider that profit and you're maintaining a property that's being rented out. So in that sense, I think there can be some tax advantages because you're running a business. Now, I would just verify with the IRS. You probably want to look more into this. Are there any contracts written to having properties rented out to family members? I would think not. I don't think there would be a problem of doing this as long as if you're not giving your child money to pay for the rent and it's coming back to you. I would probably point you to going to talking to your accountant or maybe a tax attorney just for further clarification if you are confused. But then again though, like I said, any rehab that's done on an investment property is open to tax advantages. So great question there, and hopefully I answered it or that was enough to answer. And if you guys out there that are watching this video, if you have any better suggestions, definitely leave a comment below for this one, because I think that what this individual asking here is actually very important and super valuable to the community. I am running into a financing issue that I can't find the answer to anywhere I search. I am looking at financing options for the next property, and what I wanted to do is set up an LLC, have investors, friends, and family put money into the LLC, and then I would use that money as a down payment. I would pay the investors back with a fixed rate loan, and I would retain 100% ownership of the LLC. However, I just found out that this is most likely illegal, especially for investors are non-accredited. Now I am wondering if the investors could be managers in the LLC, have 0% equity, and loan the LLC money. All right, so the question is, this individual is wondering if the investors could be managers of the LLC, have 0% equity, and loan the LLC money. I mean, yeah, so this is very common in the real estate world where people will give you money and you're gonna have, like, let's say a managing member that's controlling where that money is going for investment deals. This is very common too in apartment complexes. You have a general partner that runs the entire deal and you have your limited partners just giving money into the deal. So in that scenario, it's not illegal to have outside investors give money to you and you are the managing member. You would just have to write a contract up that would state that they wouldn't have any control in the business. And I would recommend just looking up online. There's a lot of information on how LLCs are structured. You can have one managing member and 20 members in the LLC, but only one person's controlling how the funds are being moved around. So I don't think it's a problem, and definitely allowed inside of an LLC. So thanks for asking that. It's a good question. I am new to real estate investing. I plan to buy my first property before the year is out. I noticed some turnkey companies, Norita, Roofstock, etc. wanted some opinions on buying turnkey or buying a rehab myself. By the way, I'm looking to invest outside my home state. Thanks in advance. So what this individual is asking is saying, should I buy an investment property outside of my area, and should it be turnkey or should I buy something and fix it up myself? So the first thing that comes to mind when I hear this is hopefully you have considered that you have time to actually rehab it yourself, or you are okay with having managing members with boots on the ground to rehab it for you. So I think that's the first question you ask is, can you manage the time and potentially go out there on site to do weekly or monthly inspections to make sure the rehab is going okay, if that's the route you choose. Going a turnkey method is totally acceptable as well. It's more off hands. And at that point, the next thing I would consider is, how are you going to manage the property? Are you going to have property management? Or are you going to manage it yourself from a distance? And maybe you have a friend or family that can drive down there every few weeks just to make sure the property is running professionally and safely. So in terms of your question, which one should you do? Should you rehab it yourself, or should you buy a turnkey property? That ultimately depends on how much time you have and what kind of risk are you willing to take. Obviously, a turnkey is less risky because the rehab is fully done. You just buy it and then now you just have to rent it out. And then again, buy and hold, you got to figure out, can you actually rehab it yourself by going down there, or are you okay with trusting people to do the work for you outside of the area that you're willing to drive? Good question. Newbie question: if I buy a multifamily as an owner-occupant with an FHA loan, then plan to turn around and rent all units after a given period of time, will I be unable to secure an FH loan for my next property? Is this why people refinance in the BRRRR strategy? Great question here. So, typically you can only have one FH loan active at a time under your name. So, unfortunately, you can't just keep getting FHA loans, especially if you want to do that. Now, what you can do, let's say you buy that multifamily, unit, and you live in it for some period of time, and then you fill your owner occupancy limit with another tenant. You can change that loan into a conventional loan, which basically would change how your loan is set up to a conventional loan. So that would mean then that the type of loan that you have is not an FHA loan now, it's a conventional loan, and there's different terms for that. Typically you can get this with a smaller community bank. Some banks will, because it is a conventional loan and investment loan, they may require more equity in the deal. So I've seen 15%, 20%, 25% down. You're going to want to run the numbers to make sure you're not over leveraged in that scenario and make sure it still makes sense for you. And then you can go and get another FHA loan once you cancel the one that you already have. Now another question you asked was, is this why people refinance doing the BRRRR strategy? I would say no, not necessarily. The reason why people want to do the BRRRR strategy is to refinance and get their money out, so liquidity, and to again go do another deal. So that's a repetitive process that will allow you to expand your portfolio over time and build long-term wealth. Our current home has a 3.75 rate, and we are refinancing that to 3.25. Or we could get about $60K out on a cash out refi with 3.5% interest. That would increase our monthly mortgage payment by about $300, and I don't think we could actually sell our home for the newly appraised value, about a $15K difference. Is it worth to do a cash out and invest that money in a BRRRR rental? Tight time crunch to make that decision. Thanks. Okay. So I actually would propose to you a combination of solutions to this. So I would actually encourage you to run the numbers and verify, refinancing it down, losing the 0.5%, if that's going to be, any big hits in terms of your monthly payments. And another option I would do on top of that is I would talk to your lender and talk about a HELOC, which stands for Home Equity Line of Credit. And essentially what this means is that you don't actually have to refinance your home. Basically, you get the amount of equity that you have in your house can be essentially a credit limit. So there's going to be a certain amount of interest charged when you use it, but not when you use it. And that's what's really awesome with this setup. So you could have $60K in equity under a HELOC, and it's available to you at any minute. So if you find a deal and you use 20K of it, it's like a credit card. You swipe, you spend, you pay interest on whatever that HELOC rate is, and then once you refinance the next property or sell it or make profit off of it, you can pay back off that 20K and you have that full balance of 60K HELOC money available to you. So that would be my best recommendation. I would, I would actually discourage, and if the bank doesn't want to give you a HELOC, okay, I think the 60K cash out refinance is probably your next bet. Getting 60K cash for an extra $300 a month is not that bad of a deal. Actually, that's really cheap to have that money available to you, and it's extremely liquid. So that would be my proposal step phases in going to try that out. For example, I want to use the LLC when I do business with property managers, contractors, opening bank accounts, accounting, cash flow, taxes, etc. But at the same time, the properties for the mentioned transactions are under another entity. Can we do business with the LLC even though the property is not under that LLC? Are there ramifications here? The house will not be under the LLC as to not trigger due on sale, as rarely that may happen. Very interesting question. And to answer this is yes, you can have another LLC do all these expenses and manage the other LLC, which might have that property under under title. So this is also common too with a lot of people that have many homes. You can have one managing LLC that's controlling all the LLCs below it, or even an external LLC that's owning that property under its name. So that is acceptable. Again, guys, I'm talking about apartment complexes because that's where I'm gaining a lot of knowledge and feedback and experience on. If you have an apartment complex, what I have seen is you'll have one LLC that is managing the other LLC which owns the apartment complex. So in this scenario, you have your managing LLC and then you have the owner LLC, and they work hand in hand together, and you can run your taxes in that scenario. It's very common. I would recommend talk to an accountant to help you set it up, and you should be okay and good from there. Great question as well. Alright guys, that's all the questions that I have in this video. This was episode 3 of the Real Estate Deep Dive Forums. If you like this video, definitely give us a thumbs up and let us know in the comments below how we are doing. Thank you guys again for checking out this video, and I hope you have an awesome day. Take care.